So crypto taxes just took a bit of a chill pill. Never thought I'd say that. Let's cover what's going on with these new crypto tax laws, why they got disrupted, and who it will impact. Back in November 2021, Biden signed this bill called the Infrastructure Investment and Jobs Act, and it does a whole lot of stuff. Rehabs roads, bridges, waterways, spends more than $2 billion on ferries. Seriously, ferries are mentioned 33 times in this bill. Big ferry is all over this bill. Anyways, this bill contains about $550 billion in new spending, and it was said to be paid in part by crypto. And that sounds flashy, but in reality, they plan to pay for about 5% of it with new crypto taxes over the course of several years. The bill outlined a few new crypto laws that really got the crypto community in a bit of an uproar a little while back, but it turns out that might not happen, at least for a while. See, all these new laws are supposed to go into effect January 1st, 2023, so the next tax year. They'd start collecting all of this crypto money, and finally the country can buy more ferries. I mean, it's about time, America. And maybe that won't happen. I'll go more in depth in a minute, but a whole lot more paperwork would need to be sent to the IRS every year starting in 2023. And exchanges are sitting there with paperwork essentially up to the ceiling saying this is an impossible task in that time. Coinbase said they would need at minimum 2 years to make this happen, which is pretty crazy to think about, but I suppose the layoffs probably haven't helped. I like to imagine that they just have like one guy left in their accounting department, just on the brink of mental breakdown. He's tasked with sending like 10 million customer reports to the IRS. I don't envy that guy. But it's looking like, yeah, this probably will be delayed, but there hasn't been an official statement just yet. However, essentially everyone in the know is like, yeah, this is not going to happen. The head of policy at the Blockchain Association said, given the scope of work, we encourage the Treasury to extend the deadline. And it turns out that there have been similar delays with financial reporting laws like this in the past, so it's not really a big leap for this to happen again. Now, there's probably two questions you're wondering right about now. One, what are the laws that actually got delayed? And two, how can I commit tax evasion from the comfort of my own home? And unfortunately, I can only answer the first one because YouTube demonetized me last time I talked about crypto money laundering. It wasn't financial advice, YouTube, okay? But now would be a good time to mention my private platform, Finova, where we have a huge successful investor community, and this is more important than ever in a bear market. We have live coaching every single day, trade signals every single day, and guess what? We just launched a 7-day free trial, linked in the description below, so try it out. Okay, the laws. The big one is as of 2023, crypto exchanges were supposed to report all kinds of customer information. So let's look at the actual bill. Here on page 912, this mess of words basically says any broker who processed a transfer in a calendar year of a digital asset would need to report all account and transaction data to the IRS. And brokers would need to treat transfers like they would cash, which means transfers over $10,000 have to be reported. But wait, there's more, because what this essentially means is any platform that you use to transact on with crypto will have much higher KYC requirements. So goodbye are the days of anonymous exchanges. That's why this is very likely being delayed. But why does the IRS want all this extra reporting and work anyways? I mean, most people pay their crypto taxes already, and big exchanges like an FTX or Coinbase already have tax information that they report. Well, it turns out there's a big thing called the tax gap. Basically, the IRS is doing this big overhaul on all things, not just crypto, in order to collect proper taxes. They say that the tax gap between what they actually receive, what they collect, and what they should have received in 2019 was $600 billion. They were $600 billion short somehow on tax collection. And they believe that this is going to increase to $7 trillion in the next decade if they don't solve this right now. What they found is that people pay their proper taxes when they know a secondary entity is also reporting their information. Basically, the honor system doesn't work so well in the US, and I mean, how surprising is that? This country was kind of founded on tax evasion. But it turns out that when people estimate their own income on, quote, less visible sources, crypto, people only pay an estimated 45% of what's due. Therefore, by making crypto exchanges report all trade, customer, and income data, they think tax compliance could reach that 99% accuracy number. That, again, is very likely to be delayed. Now, these laws have brought up two issues that people are pretty salty about. The first is record keeping. Many crypto holders, they might have a hardware wallet, a few DeFi wallets, and a few centralized exchanges. And in many instances, the exchange is probably going to have some incorrect data. Maybe the cost basis is wrong, or they think there was some taxable event when perhaps there wasn't. But they're forced to report all of that, whether it's absolutely correct or not. This means that you have to keep meticulous records of your transactions in case what's being reported is false. That way you can say like, hey, no, this is wrong because of X, Y, and Z. Once this is all streamlined, the whole system will likely work better than it currently does because right now crypto taxes are a total mess. But the transition years, now probably 2024, I expect things to be more difficult than ever. There's actually even an entirely new 1099 dropping. I know, it's hardly the most anticipated drop of the year. The 1099 DA is currently in secret development. I actually couldn't even find a picture of it, but I'd be willing to bet it looks something like this. And I'm also assuming that DA stands for digital assets, but don't quote me on that. This is top secret stuff, so. Now, this bill brought up another major piece of contention in the crypto community, and that's the definition of a crypto broker. On page 911 of that monstrous bill, they expand the definition of broker, and it sounds like they could tack that categorization on essentially any crypto-based service, meaning not just crypto exchanges, but also miners, DeFi operators, and stake pools. That would be bad. Very bad, because it means that they too would need to collect and report trade and customer information to the IRS, essentially disrupting the whole point of DeFi. Now, since that has happened, the Treasury has reportedly said that they're going to provide exemptions to businesses who are not actually brokers, but people are still a bit uneasy on that point. But all in all, it looks like this stuff will likely be paused for at least another year, and that means another year of crypto billionaires lobbying the government for softer, easier laws within the space. Now, if you're concerned about crypto taxes, I have just the thing for you. Today's sponsor, iTrust Capital. With iTrust, you can actually place your crypto in a Roth retirement account. This means you can buy, sell, and trade crypto and pay no capital gains on your wins. This is absolutely amazing for traders. With the Roth, you pay your tax upfront when putting money into the account, and then at retirement, you pay no tax once you start pulling out at age 59 and a half years old. This is probably the most simple way to save on all capital gains taxes. They'll be linked in the description below, and if you use that link, you'll receive $100 in Bitcoin for free just for joining. Now, I'd like to thank you so much for watching. I'm Max Maher, and I hope you have a profitable day.